Hey future millionaires, if you are looking for a strategy to grow your money over time consistently so that, eventually, this can pay for all your splurges in life, without ever running out of money and actually generating more and more automatically without you even having to deposit a penny more. Today's video covers this in detail as I am going to share with you how a well-structured dividends portfolio should look like, and how you can get started to build the portfolio that will bring consistent wealth every month and year for you to live comfortably. But first, let's discuss what dividends are and how they actually work. Dividends are compensations issued by certain companies to their shareholders on a quarterly basis. The percentage they choose to pay back varies from one stock to the other, can be affected positively or negatively according to how the company is performing. When companies make money, they have multiple options, such as reinvest the money to help grow the business, buy back some of their shares on the stock market, or distribute earnings to shareholders as dividends, to name a few. For instance, Coca-Cola stock typically brings a return of 3.06%, but if they exceed their performance on earnings report, they might throw an extra 0.5 to 1% to investors. This is what is known as a special dividend. On the other hand, it's important to know the different industries stocks are in, since this will be key in identifying the top players and building an even balanced portfolio that can withstand the most fierce of the storms, or close to. For that, let's assume you start with a $1,000 investment. If you don't have this kind of money yet, then take a zero off and make it just $100, although the more the better, especially when getting started. So that time can do its magic, and compound interest helps that initial investment turn into much more. So, in terms of simplicity, let's take $1,000 and invest them across 10 different industries. And before you say something along the lines of price differences, yes, let me tell you about something called fractional shares. With this, you can basically allocate a specific amount of dollars into one stock instead of having to buy the full stock price, thus still evenly distributing your $1,000 across 10 different stocks and markets. Here is a list of industries where you can spread your initial investments for a diversified dividend return. Notice it's 11 total, yet in this video we are focused on trading only 10 of them, so pick yours. Beginning with the energy sector, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. Furthermore, I will include a screenshot of some of the most popular stocks in each category to help you decide. Another consideration you'll want to make is the risk level. If it's true that we are investing into multiple industries, each of these industries has stocks that are riskier than others. And yes, we want to get a nice looking return on our investment, but we don't want to get out of balance by only pursuing high risk stocks. At the same time, we also don't want to necessarily stick to the old dinosaur stocks all across the way. A good strategy is to invest into some riskier stocks while balancing with classic companies that are likely to stick around for the long run. With this, you are securing diversification all along the way. Remember this: the higher the yield, the higher the risk. So choose carefully. Be careful when you see those exuberant looking dividends at 16% or more. Don't let yourself fall for the lure, as these are known as dividend traps and might not last for too long. When investing into dividend stocks, another factor to look for is the schedule of these earnings. After all, you don't want to be invested only in companies reporting on December of each year, leaving you empty-handed the rest of the year. The ideal cycle would have stocks reporting each quarter and at different times, so that you can collect a bit here and there each month all year round. Investing in quarterly dividend payers means that you only need 3 stocks to collect dividends each month. Here is a calendar with some of the top players in different industries reporting at different times of the year and their dividend yield. With this, you can easily calculate how much and when your money will land. Once you have selected the stocks you want to invest in for the long run and set up your dividend portfolio with a diverse assortment, it's time to jump to the fun part: collecting your dividends and growing them. But how much do you actually need to live off dividends? Let's use the following examples to help you better understand your situation, which might be different than mine or someone else. The key to this analysis is not how much you need now, but how much do you think you'll need it in the future, say 10 to 20 years from now. So, let's see. If you spend around $40,000 a year to support yourself and your family, and based on a portfolio with a dividend yield of 3%, then you'll have to divide those $40,000 by 3% to find a minimum portfolio value of $1,333,333. $40,000 divided by 0.03 equals $1,333,333. This is your number if you expect to have your money generate $40K a year without you having to work. But like mentioned, not two people are the same, so let's compare a couple more situations that might accommodate better your personal needs, and let's do this by risk, whether if you want to go berserk mode and achieve financial freedom right away, or if you prefer the long, and often boring, but safe way to build your dividend portfolio. High risk tolerance. You want your portfolio to pay a dividend yield of 6% per year. $40,000 divided by a 8% yield means you'll need to invest about $500,000 to live off dividends. $40,000 divided by 0.08 equals $500,000. Medium risk tolerance. $40,000 in annual spending divided by a 4% yield means you'll need to invest about $1 million to live off dividends. $40,000 divided by 0.04 equals $1 million. Low risk tolerance. $40,000 in annual spending divided by a 2% dividend yield means you'll need to invest a total of $2 million to live off dividends. $40,000 divided by 0.02 equals $2 million. Big differences, as you can see. Basically, the higher the risk, the less the money, but the higher the downside. A good rule of thumb is to go more aggressive as you are young and more conservative as life progresses. These numbers are, of course, estimates. You can never be entirely sure how much you'll spend or exactly what dividend yield you'll receive in the future. Both amounts can and will fluctuate, so make sure you build in a buffer according to your risk tolerance. Ultimately, but not least, make sure you select the option to reinvest your dividends into the securities, stocks, so that the money starts creating a snowball, compound effect. This varies from one broker to another, but make sure you do this early on to avoid missing out on reinvesting your dividends. Living off dividends is a long-term strategy and is more easily achieved when combined with a growth strategy, unless you have a very hefty income. By combining growth and dividend, you ensure your money doubles every couple of years, and this adds more weight into how much you receive from the dividends, thus reinvesting that money and accelerating once again the growth of your portfolio. If you want to know more in depth how to create a solid growth portfolio and build it from 0 to 10K, check out this video where I detail step by step how to invest and how long it would take for you to grow your money. If you find this content valuable, please like and subscribe and share with your friends. See you next time.